The tensions are on the rise in the Strait of Hormuz, the narrow choke point that carries roughly about a fifth of the world's daily petroleum supplies and over 20% of the global LNG. The passage is just about 33 kilometers wide at its narrowest point, and it yet remains primarily the key artery for the global energy markets. Iran announced the temporary maritime restrictions tied to its smart control military exercises. Sections of the waterway were partially shut for a few hours, and shipping traffic has slowed as tankers anchor or wait in the Gulf of Oman rather than risk entering the channel during the live fire drills. Live vessel tracking shows a cluster of ships near Bandar Abbas in Iran and ports along the United Arab Emirates coast. While there is no full blockade, some vessels are in fact waiting for up to about 100 miles from the strait before proceeding from there. Naval escorts, including the United States and allied warships, are maintaining a visible presence in the surrounding waters. So as Iran conducts its military exercises, there is no physical closure of the main shipping lanes. But the uncertainty is enough to rattle the markets. Insurance premiums for ships in the Gulf have jumped and freight rates have climbed. Unlike the Red Sea, there is no water-based alternative to the route. If the Strait of Hormuz is blocked, then much of the Gulf oil is trapped with only limited volumes that will be able to bypass via pipelines in Saudi Arabia and the United Arab Emirates. The Strait of Hormuz handles an estimated 15 million barrels of crude oil every single day. Saudi Arabia remains the largest crude oil exporter through this passage, accounting for nearly about 38% of the volume, followed by Iraq at 22%, the United Arab Emirates about 15%, Iran at 11%, Kuwait at 9%, and Qatar at 5%. Now, oil prices have witnessed some 4% rally this week, with Brent crude currently holding at about $71 a barrel as traders are weighing in the geopolitical risks in the ongoing diplomatic talks in Geneva. Major importers such as China and India, which receive the vast majority of this oil, face the highest risk of supply disruption. LNG shipments from Qatar are also under close watch as there is no alternative route for gas exports to reach Asia or Europe. The ripples effects extend beyond energy. High transport costs are bleeding into the petrochemical prices and broader inflation concerns, while diplomatic efforts are underway to prevent any kind of an escalation. The Strait of Hormuz remains the world's most critical and volatile energy pressure point.